Hey guys, welcome back. It's Biz Talk with Mike. I'm Mike Seifert. Hey, it's been a little bit of time here, a few weeks since I made the last video. Apologize about that. I'm going to try to get some more videos out there as soon as possible. But today I want to talk about assets versus liabilities and actually add in the featured book, Rich Dad, Poor Dad by Robert Kiyosaki. Now, Robert Kiyosaki is one of my favorite authors when it comes to business books, and he's an author of many other books. But if you're somebody that wants to learn about assets and liabilities, it's a good starter book just to kind of get the basis or the basic understanding of the differences. And so I'm going to quickly explain to you the actual differences between assets, liabilities, and what Robert Kiyosaki's main idea in the book is. So basically, an asset is something that puts money into your pocket. A liability is something that takes money out of your pocket. And this is according to the book Rich Dad, Poor Dad. But it's also general knowledge for business owners and people in business that understand how assets work and liabilities work. And so, let's talk about an asset. An asset can be really anything. But according to Robert Kiyosaki, an asset is something that puts money in your pocket. So let's say you go out and buy a car for, let's exaggerate here and say you bought a $150,000 car and you make $60,000 a year. And first of all, you probably wouldn't qualify for that have a car, but let's say you make $90,000 a year and you buy $110,000 vehicle. That, according to the book, and in my opinion, is a stupid investment. It's not even an investment. So you're going to buy what you think is an asset that's worth $100,000. When you drive it off the lot, it actually depreciates like 20%. So you're down to about $80,000 to $90,000 the first year, and then after year like 3 and 5 especially, you're down to like half the price of the vehicle. So this is an example of someone thinking this is an asset when in reality it's a liability. And the loan against that vehicle, the loan is actually the asset of the bank. So the bank that loaned the money on that car, that's actually their asset because that puts money in their pocket. The car depreciates, number one. Number two, you have a monthly payment with insurance that takes money out of your pocket. Now, the vehicle itself is not producing income for you in any way. It's not making money. So this, in reality, is not only a bad asset, but it's bad debt. It's debt that you're spending money on, and it's not putting money in your pocket. Now, let's talk about the same example. Say you wanted to start, a business in the an ice cream truck business. Kind of a silly exaggeration, but let's say you bought a $50,000 ice cream truck, and you're in a fairly good area, and there's a lot of kids that buy ice cream. This $50,000 makes perhaps $15,000 to $20,000 a year, and so that is called a real asset. It's an asset that puts money into your pocket. So you're driving around this ice cream truck and you're actually making money off of it. After you pay the monthly payment and all that, it's what's considered good debt. Now the bank that loaned you the money, that's still their real asset, the actual loan, because they're making interest off that. But the asset that you bought, even though the truck is depreciating a little bit, it's actually generating business income. And so that's what Rich Dad Poor Dad talks about. An asset, like this ice cream truck example, that asset produces income. Let's just say it produced $50,000 a year. It's virtually 100% return on your investment when you bought the truck for $50,000. Even though it's depreciating asset, that can be written off against income. So there's a lot of things. That's another topic, taxes and write-offs. But when you buy an asset for a business or you buy a business, you want to accumulate assets. When you buy a house, for example, let's get into real estate. When you buy a house, if you buy a house for yourself and your family, that house technically on a banker's balance sheet is an asset, but in reality, in the business world of making money and actually becoming building wealth, that house is a liability on your balance sheet. Even though it's a real asset according to on paper, in real life, an unspoken rule is that house is really a liability because it's going to cost you money. Even though it's appreciating, say the house goes up 20%, that's fine. You're going to make a capital gain. But that house is actually a liability because you're losing money with taxes, with insurance, and with the monthly payments, and you're paying interest. Again, the bank loan, the bank and the mortgage in particular the loan that was issued to you through the bank, that's their asset. They're actually making interest off you. So now let's talk about this again in the opposite realm. If you were to buy a house, a rental property, let's say you buy a $100,000 rental property that brings in $800 a month. After everything is accounted for, your mortgage payment, your maintenance, your insurance, your expenses, whatever they may be, and if you're ahead by, let's say, $150 to $200 a month, then that is considered good debt. Number one, the loan is good debt because it's actually helping you to make income on money that you necessarily didn't put up all the $100,000, but you're making a positive cash flow per month, it's called. So you're actually making $150 to $200 extra per month on a property that you borrowed the money on, and now the house is considered a real asset. It's an asset either way, but in unspoken terms, now it's a real asset. It's a business asset. That's just like any other asset, like a piece of machinery. If you buy something just for fun, personally, that's where it's bad debt. Now, if you have a lot of money coming in, go ahead and buy it, but make sure that you have assets, 5, 10, 20, whatever it may be, assets producing $2,000, $3,000, $4,000 a month, so you can go buy your $1,000 per month car. Still a waste of money. I wouldn't do it, but you want to have assets that are producing the income first before you go and buy something personally. So you always want to build up a cash flow or a income stream before you go ahead and buy a liability, such as a vehicle. Vehicles are the worst investment you can make if you're personally going to do something. And with any vehicle, you can lease and you can buy, and that's another topic. But leasing, you're basically paying for security of the vehicle. If it breaks down, it's fixed automatically. It doesn't cost you anything extra. With buying a car straight out, it's just a lose-lose situation. So the point is, you want to get an income-producing asset. Now, on the other hand, a liability is the opposite, and it's the same thing we've already spoken about. Going back to the car situation, if you purchase a personal vehicle for $1,000 a month, and that vehicle is not producing income, it's just, hey, I want to look cool in front of my friends and family, that's fine if that's your preference. But remember, that is actual liability. On your banker's statement, on your balance sheet for the banker, it's considered a personal asset, but it's not really an asset in the world of business because you're losing money. That car is not producing income. Now, if you buy that same car and you start a transportation business and you're driving people around, maybe you're using it for Uber, okay? That's a great example. You buy a car that's fairly inexpensive, a $20,000 Honda or Ford, a Ford or anything that can carry people up to 3 or 4 people. Now, when you're Ubering, that car now is becoming an asset because it's bringing in money. You can use that car to produce income. So if your car payment's $300 a month and you're bringing in $1,000 a month from Uber, now the car is an actual asset. So that's the difference between assets and liabilities. You don't want to accumulate a ton of liabilities. A lot of younger people in their 20s, and I even did this myself in my 20s, they accumulate several vehicles and they buy this and buy that. They want to look cool at first. They want to show that they're having success with their new job. What they're doing is just burying themselves, especially if it's credit card debt. You're buying stuff that doesn't make you money on credit. Live frugally in the first 5, 6, 7 years out of college or out of school. I know it's hard, but you don't want to go spend $50,000 on a vehicle just to show off and say, hey, look at how successful I am. There's nothing to prove. When you're older, you figure out that there's nothing to prove out there. It's your survival. It's for your family. And sure, it's great to have success. It's great to show off things here and there, but make sure you can afford them. Don't go buy a Range Rover when you're only making $50,000 a year. Remember, if you buy a $100,000 car and you're worth $1 million, that's 10%. A $100,000 vehicle is 10% of your net worth. That's insane. So if you're going to buy a car cash for $100,000, you better be worth at least $3-4 million to buy that car cash, because it's really silly to buy a car that's 10% of your net worth if you're worth $1 million. So I hope that today's lesson helped you in some way. If you have any questions or concerns, comment below. But again, thank you for your time, and I look forward to doing the next video. Thank you. Have a great day.